If you own a home in high-tax states like New York, New Jersey, or California, you are likely losing thousands overpaying the IRS. The solution is the newly expanded state and local tax deduction, which allows you to write off up to $40,400 in taxes you've already paid. To claim this, we need to accomplish three things: calculate your specific deduction amount, verify your income against the strict new limits, and finally, you must properly report the finalized number on IRS Schedule A. Getting these steps right means keeping thousands of dollars of your own money. Getting it wrong means sending a massive, unnecessary check to the federal government. On July 4, 2025, Congress passed the One Big Beautiful Bill Act. For years, the deduction was capped at $10,000. Under the new law, that ceiling quadrupled to $40,400. The cap rises 1% annually, so we're using the exact 2026 tax year parameters. You only have a 5-year window to use this. In 2030, the law expires and the cap snaps back down to $10,000. Step 1 is determining what actually counts. You can write off 3 specific things: your state income taxes, your local property taxes, and your state sales taxes. You are only allowed to claim these local taxes if you itemize your deductions on your federal return. You cannot take both the standard deduction and this local tax write-off. For a married couple filing jointly in 2026, the standard deduction is $35,100. To see which option saves you more, you add up your local taxes, your mortgage interest, and your charitable donations. If those combined expenses do not exceed the $35,100 baseline, you should take the standard deduction. If they do, you itemize. This graphic shows the income restriction. The IRS calculates your eligibility using your Modified Adjusted Gross Income, or MAGI. For 2026, if your MAGI crosses the $500,500 limit, your deduction shrinks by 30 cents for every extra dollar you earn. Let's apply this to a married couple, David and Sarah, who own a home in New Jersey. They have a household MAGI of $450,000. Over the year, they paid $25,000 in state income tax and $15,000 in property tax. That gives them a combined total of $40,000 in eligible taxes. Because their $450,000 income stays safely below the $500,500 threshold, they keep the full $40,000 deduction. At their 32% federal tax bracket, subtracting $40,000 from their taxable income means they lower their IRS bill by exactly $12,800. To process this paperwork, you will use IRS Schedule A. Look directly at line 5. On line 5A, enter the total amount of state and local income taxes withheld from your paychecks. If you choose to deduct state sales taxes instead, that number goes here too. Next, check your county tax bills. Your total real estate and property taxes go on line 5B. Add those together and put the combined total on line 5D, making sure it doesn't exceed your personal capped limit. You then transfer that final deduction figure directly onto your main tax return, Form 1040, at line 12. Before filing, check for 3 common errors. First, remember you cannot claim this local tax write-off while also taking the standard deduction. Second, do not include business property taxes here. Those belong on completely different tax forms. And third, you must choose either state income tax or state sales tax. You are legally forbidden from deducting both. Filling out these lines accurately guarantees the IRS accepts your return without triggering an automated audit. Keep 2 numbers in mind as you prepare for April: the $40,400 maximum write-off and the $500,500 income limit. Once you verify your income qualifies, list your local taxes on Schedule A and carry the combined total over to your Form 1040. Utilize this while you can. This expansion disappears at the end of 2029, and the cap will drop straight back to $10,000. Now that your property taxes are covered, we need to handle your home loan. Subscribe to the channel so you don't miss next week's breakdown of the mortgage interest deduction. Tracking these expenses throughout the year is the most reliable way to retain your own wealth. This video is for educational purposes, not formal financial advice. We're not affiliated with the IRS. Please consult a CPA regarding your specific tax situation.